share with you guys this clip. So Matt McKeever shutting down the YouTube channel. We announced this last week. So he is shutting down the Matt McKeever channel, but it is being rebranded into the Canadian Real Estate Channel. So we're just going to watch the first few minutes here of this clip, and I highly recommend that you watch the entirety of this video to follow. So I'm just going to play this for you guys. It's super exciting. We got a lot of cool things coming up for you.
Welcome to the Canadian Real Estate Channel. We're releasing a video every single day in 2020. We're going to become the content kings of Canadian real estate. Hello Canada and YouTube. The Canadian Real Estate Channel is really designed for you, Canadian real estate investors, whether you're an aspiring investor or you've been there, done that, got the t-shirt, but you're looking to take your game to the next level. My name is Matt McKeever and I originally started investing back in 2010. Back then though, there wasn't nearly the same sort of content out there on YouTube for real estate investors. In fact, I was struggling alone all by myself, constantly questioning whether I was crazy for wanting to get into real estate investing. Friends, family, well-meaning coworkers, they all had great reasons why it was a terrible idea for me to get into real estate investing. And yet I had clients as a CPA that were doing their taxes and seemed to be doing quite well owning real estate investing. This disconnect was really concerning for me, so I jumped into the world of personal finance and discovered financial independence. That really opened up a whole new world for me in regards to what was possible with my relatively, average income. And so I started buying properties back in 2010. My first property I decided to house hack in. So essentially what that meant was I bought a house, had a bunch of friends and a couple strangers move in with me, and was able to live for free. Live for free. Live for free. This really changed the trajectory of my entire financial life as well as just my regular life. And so back in 2016, I started a YouTube channel where I wanted to start documenting my journey. Maybe you guys have seen some of the videos, maybe you haven't, but essentially I started swinging the hammer myself. I was doing all the renovations, really up there in the attic, sweating, just going crazy, trying to do my best to renovate these properties. And I wasn't just doing it haphazardly. In fact, I discovered during my approach to financial independence the BRRRR investment strategy. And so that BRRRR investment strategy stands for buy, renovate, rent, refinance, repeat. And that's essentially what I did from 2010 until 2020. I started buying rental properties one at a time, then a couple at a time, building out my portfolio and just learning from all the other real estate investors here in Canada. It turns out there's actually a lot of us out here in Canada that are investing in real estate, just not too many people are documenting their journey. And so
all right, I am going to leave it right there, and I highly recommend that you watch the remainder of this video. I will put the link in the comments section. So this is for sure going to be a huge space where there's going to be a ton of real estate content going forward. There already is a ton of real estate content on Matt's channel, but it is going to explode even more. We're going to have a ton of special guests who are going to be featured on the channel, including yours truly, Rebecca Lynn Matheson, aka the Canadian Cottage Girl, as well as Josh and Aaron. So they actually have Findlay Finance Fridays every single Friday. You can tune in and have your mortgage questions answered. So that is definitely a great spot to go in and check out some fantastic content. They pump out videos all the time on their channel. So if you aren't already following them, make sure you hop over to their YouTube channel. And guys, if you could actually put your YouTube channel link just in the comment section as well. So they have their own YouTube channel as will be featured on the Canadian Real Estate Channel as well. So guys, thanks so much much for tuning in for today's Wednesday webinar. We host these things every single week live at 6 p.m. We've actually been doing this since 2020, since actually October 2020 was the first one. So just to give you guys a little bit of background, I actually started in the real estate investing space back in September of 2020. So right after COVID hit, and I have been surrounded by incredible mentors along on my journey, including Matt McKeever, including Adam Martin, who is my co-host on this Wednesday webinar every single week. And I have absolutely been able to accelerate during this time and in this space. So Adam and Matt actually run the largest real estate wholesale business in Canada, and I have had the pleasure of working alongside them and learning from them as I have gone through this journey over the course of the past year. And I am definitely keen to actually take down my own property. So I'm actually looking for a cottage property, and I want to document the whole thing and show you guys the journey of taking down my first investment deal. So I'm really excited to have Josh and Aaron on the channel, because we've actually had them on before, and we've actually had them on the Problems or Profits podcast. Now, the Problems or Profits podcast, we've just launched season 2 today, so make sure you tune into that as well. We had 20 episodes for season 1. Matt and I host that, and we had just some killer guests that came on through season 1. So we hit over 5,000 downloads through season 1, and we're definitely looking to continue to expand into season 2. And having fantastic guests like Josh and Aaron come on to the podcast. We always love hearing their story, and they actually built their business and expanded quite significantly through COVID. And that truly is a Problems or Profits moment. So I would love to hear from you, Josh and Aaron, just with a little intro for people who are maybe on this webinar who haven't come across you. Now, I think it's hard at this point because you guys certainly are the content kings in mortgages in Canada. So why don't you guys just give a little introduction as to what you do and why you do it?
Sure. Thanks so much for the introduction, Rebecca. For anybody who doesn't know us, I'm Josh. This is Aaron. This is Aaron. We are the Findlay Mortgage Team. We are the owners of a Dominion Lending Center franchise. We're based out of the Cambridge and Guelph area. We specifically realized about a year and a half ago that there was a gap in the financing process for investors. There was a lack of knowledge, a lack of information out there, and a lack of really premium brokers to be able to offer different solutions to the market. So we decided that we were going to focus on that. And one of the pillars of what we do is create value and content for the people who are watching our content. So we partnered with Matt a little while ago, about a year ago, to start creating content. And that's how we are here today in front of you guys. So if you haven't checked out any of our videos, we've covered everything from A mortgages, B mortgages, private mortgages, how much it costs, what to expect, how to get a mortgage, and even like a little bit of an in-depth look into maybe some more complex terms and strategies. In regards to what we do and how we do it, we try to be the best at what we do. We're always continuously learning, trying to find new products and services to help investors kind of get a competitive edge. We understand that the banks aren't on your side. Eventually, they are going to tell you no or you can't. And we are the ones that tell you can. So there's always a solution. It's just a matter of finding that solution and finding the right capital or the right strategy to be able to execute on that solution. And that's why we work so well with Adam and Rebecca and Matt, because when we work around people who find yeses and then don't linger on no's, a lot of things get done.
I can really appreciate that, guys. So thanks for filling us in on some context here. So I'm just going to go over a quick agenda for the day. So thank you guys all for sharing your Wednesday evening with us. I mean, there's plenty of other things you can be doing on a Wednesday evening. So it's always a pleasure to be able to connect with like-minded individuals who are looking to invest in real estate. So definitely really encourage you guys to participate today. We will have actually a live Q&A where you can ask any questions that you have regarding financing or regarding mortgages. These two are definitely the go-to guys. They are problem solvers in this niche, and that's really what they've built their business on, is solving problems for investors. So I definitely really encourage you guys to take advantage of the fact that you can ask them questions live on this webinar. I also encourage you guys to turn your cameras on so I can see your beautiful faces, and make sure you are tagging us on Instagram. So we're all on Instagram, the Findlay team. Make sure to give us all a follow. We've got Adam JD Martin's Instagram handle here, my Instagram handle at Rebecca Lynn Matheson, and at the Findlay team. So I encourage you guys to take out your phones, take a photo of the slide, and tag us on Instagram. We'll definitely reach out and repost if you do. So I definitely encourage you all to do that. Now, one key real quick announcement is I'm actually giving away a book right now on my Instagram page called Own the Day, Own Your Life by Aubrey Marcus. Now, this book has been wildly influential, and I am giving it away because I really want to pay it forward and have other people engage with this book. I really do highly recommend it. So if you are looking for some sort of next level kind of professional development or personal development, this book is the source for that. So it will allow you to really level up your life. And when you can optimize each individual day in each part of your life, your business, your health, everything, you're going to be able to optimize your life with a cumulative effect. So I highly recommend that you hop over to my page if you are looking to see some sort of content that's a little bit different from what we're putting out there all the time with real estate investing information. Then hop on over to my page for some fitness tips and tricks with Own the Day, Own Your Life. Another announcement real quick here is we have the Ontario Private Real Estate Deals Facebook page. We're now over 11,000 members. So that group has grown exponentially in the past several months. And it is definitely the place where you can find your real estate off-market deals, because we encourage other investors to post to that group, as well as we post all of our private deals to that group as well. Now, if you're looking for off-market cottage deals, we also have an off-market cottage Facebook page, and this one just got to over 3,000 members. So this, we encourage people again to post their off-market deals, and we do post our off-market cottage properties too. If you found us through Facebook and maybe aren't on our buyers list yet, make sure you hop over to our buyers list. We have an email list where we send out all of our deals, mattmckeever.com/private deals, and of course, cottage deals. Cottagebuyers.com/private deals is where you can find that as well. One additional announcement before we get rolling here is we are hiring right now. So I run our cottage wholesaling business here with the team, and we also have our main wholesaling business that is all over the urban residential areas. So if you are looking for a change, make sure you submit a video application just at mattmckeever.com/join my team. That is where you can find us. If you are looking to get into the wholesaling game, definitely reach out. Now, without further ado, let's get right into how to get financing 101. So guys, feel free to take it away here.
Let's start. Yeah, I mean, step number one, I would say get your documents in order. Make sure you have 2 years of your tax returns put together. One of the first things that we're going to need from you is your information, and the whole application, process is all based off the information that you give us. So the more accurate information, the better our underwriting, and the quicker we're able to move forward. So, 2 years of taxes. If you have your T1s, great. If not, reach out to your accountant or check with the tax software that you use. Like if you're using TurboTax or some sort of home tax software, it will automatically package that up and present that in a PDF. So make sure you have those together. Your notice of assessments, your NOAs should have at least your last 2 years. If you haven't done your 2020 taxes yet, which there are some people who haven't, make sure you get to your accountant and get that stuff rolling. You will need to have your 2020 taxes up to date. I know I've had some conversations with a few investors who aren't up to date yet. So just make sure that that's all good and ready to go. If you guys have properties, make sure you have your most recent documents up to date, property tax statements, mortgage statements. Make sure you have legible leases, and the lease is all ready to go. We will need to collect those at some point. Other documents. Yeah, I mean, that's pretty much the main documents that you're going to need. If you have a property that you're interested in, have that MLS ready if you do have an MLS. If it's an off-market property, have the buyer's package ready to go. Pictures are definitely a great help for us. It gives us insight into the property that we wouldn't normally get until we have an appraisal done. And those pictures, taking a look at those right from the get-go can be a huge time saver. If it's a private purchase and needs to be done privately, and we waste, or we spend 2 weeks getting an application, submitting it into a conventional lender, then get the appraisal and find out it's not going to pass. We can bypass all that time and save a lot of time just by taking a look at the pictures right from the start. So the more documents you guys have ready to go, the easier it's going to be. And essentially you're starting a business and becoming an investor. So you should have all those things ready to go and in line, and prepared. If you have properties, like I said, make sure you have the mortgage statement, property tax, and leases, but also have maybe a spreadsheet put out. We have a portfolio DSCR sheet, so a debt service coverage ratio sheet. I'll take a look at a breakdown of each property, who the mortgage is with, what the balance is, what the principal amount was originally, what your payment is, what your property taxes are, what your rental amounts are, what your property expenses are. And we can take a look at that and get a good idea of how well your portfolio is servicing, and just gives us a little bit more insight and background into the portfolio and who you are as a borrower.
Yeah, I think documents are extremely important for us to be able to verify all the information you've given us to give you an accurate representation of the products that are available for you. But before we get into that, usually we get on a consultation, and the consultation goes a whole lot like, what are your goals? So your short and long-term goals, and why are you doing what you're doing? So it's very easy for somebody to pick up the phone and say, hey, what's your best rate? Well, that's not a strategy, and that's not a goal. Like, that's just somebody looking for the best rate. And the best rate is out there somewhere on some platform. Like, when you're calling a mortgage broker, or you're calling somebody who's going to be structuring a deal for you, or helping you grow your portfolio, or finding a solution for you, the first question isn't what is the best rate. The first question is, what are my short-term goals? What are my long-term goals? Why am I purchasing or refinancing this property, and how is it going to affect me down the road? So mortgage financing isn't necessarily about the financing that we're getting for you right now. It's about building the blocks needed to be able to build the infrastructure to allow you to grow wealth. And that's what we do specifically. So before we even get into any of the nitty gritty about documents and T1s, we really want to understand who you are, why you want to do it, and how we're going to get you there. And once we understand that, the information that you provide to us in beautiful PDF format that's labeled, we can then take a look at it and give you the product, or give you the advice that you need to be able to move forward.
I think that's the biggest weakness of what a big five bank does is, a big five bank just sees you as, a piece of revenue coming in. They don't really care what your long-term goals are. And that's not to put down every bank mortgage agent, because there are some good bank mortgage agents out there, but with them having one product, they are a lot more limited to what they can do to help you with your goals moving forward. For us, having the access to banks, having the access to monoline lenders, the private, the small commercial, the commercial, being able to, like Josh said, have a sense of what your goals are moving forward, that allows us to make sure, that we structure your first mortgage property, because that first mortgage is usually the most crucial in making sure you have a smooth transaction moving down your goals. If you're looking at BRRRR, making sure you have the right term, whether it's either an open product or a variable, to mitigate those costs. That's going to make sure you have enough capital on that refinance to get into your next purchase. If you lock yourself into a 5-year fix that either has a like a interest rate differential or a bona fide sale clause, you can very easily tie up your capital. So getting a complete understanding of your goals is crucial.
For sure.
Got it. So just got a real quick question here for you guys. So let's say we've got a brand new investor. So if they just go directly to, let's say, one of the big five banks, and they are looking for a mortgage, the big five bank that they go to, they're only going to be able to get a product from that bank that they have. So you might be looking for lending. You go to the bank and you get turned down, and then you think, oh, well, I can't buy that property because I can't get lending. But here's the thing is, like, each and every bank is different and each and every lender is different. So coming to somebody like you will be the advocate essentially for that person to get them the best product for their scenario. So you are able to not only access the big banks, but you're also able to access private money, or able to access alternative lending like credit unions, B lenders. And it really is ultimately the problem solving solution here for every single individual investor that's looking to get lending. Like if you're suddenly going out and trying to do all of this on your own with limited timelines and competing on market, it's going to be really hard for you to actually get the right product for you. But when you have somebody that you're going to that's doing this every day, you're going to be able to get the right product at the end of the day. As you mentioned, like if you are trying to burr an investment property and you get a 5-year fixed term mortgage or even longer than that, then you're really putting yourself in a pinch hole, and you're not going to be able to execute on the strategy that you were hoping to in the time period you were hoping to do it. So I think these things are all really important considerations, is starting from your why and actually identifying what that is, so that ultimately you guys are able to guide them to the right product.
100%. There are so many intricacies and so many different products and ways in which banks underwrite loans, that one bank might be very advantageous for somebody who has 3 properties but has good cash flow, and one might be advantageous to someone who necessarily doesn't have great cash flow, but the one property is debt servicing very well. There's different products for different people in different situations, and if you pigeonhole yourself with one bank and they say no, don't get discouraged, because that's not necessarily the case. Again, as I said when we started this call, there's always a solution. It's just a matter of finding the solution. And that solution might not be cheap, like it might not be free in regards to going to like an A bank, but the solution's there. And if you're an investor, at the end of the day, it's all about numbers. Does the numbers make sense? Does the cost to execute on that transaction make sense? And if it does, then you move forward with the transaction. But our job is to give you sound advice with the right products and give you the options to move forward.
Yeah, and one thing I would say too is avoid, like, obviously utilizing your network for information and experienced investors and stuff can be a crucial point to get information from, but every transaction is completely different. So you might talk to an investor who's been able to get something done because of their financial situation, or maybe they have a strong network and they're able to leverage that through a network loan, but that may not be the case for you. So just making sure that you understand that just because you hear something from one investor and something from the other investor doesn't necessarily mean it's going to automatically apply for yourself, especially when it comes down to products coming from a big 5 bank, because there are only a couple lenders that actually work with the brokers. So you're looking at like TD and Scotia. Like HSBC works with brokers, but they're not really, I don't consider them part of it, but like RBC, BMO, CIBC, these guys, like they don't work with the brokers. And there are some clients and investors that they're willing to move mountains for, and they will make exceptions and they will do it. There are some investors that they aren't willing to make those exceptions for those mountains. And you can have 2 completely different real estate transactions. So just making sure that you understand that one answer and one experience from someone isn't going to be the same that you might experience. It's good to take those and learn upon them, but definitely coming to us and talking to like an experienced broker and understanding all the options available and understanding, are these options going to be applicable to you? Just don't pigeonhole yourself in one idea or one lender, like Josh had mentioned.
Absolutely. Yeah, I really appreciate that, guys. Now, I want to hear from everyone who's in the room today. So if you're a first-time investor, or maybe you have multiple units, I want you to put that in the chat just so that we can understand kind of where you guys are coming from. So if you're a first-time investor, just write first-time investor. If you have 10 units, 100 units, 5 units, whatever that number is, feel free to share it in the chat. I want to hear from you guys. I would love to know where you guys are coming from, because everyone's at a different level, and everyone is going to be trying to get into either their first property or their 22nd property, whatever it might be. And you're going to need different solutions depending on where you're at. So as Josh and Aaron mentioned, sometimes when you get to a certain number of units, you're unable to even go through an A lender, for example. Like they may cut you off from mortgages. So you need to come up with other solutions if you want to continue to expand your portfolio. So I really appreciate you guys commenting in the comment section. We've got a few people here that are first-time investors. That's awesome. Jamie's a homeowner. We've got Mrs. Cod, who's got 2. We've got we got the first person who commented has 22 units. Shout out. Hello. Who else do we have? We have Stefan coming in from Edmonton. Wow, we've got people from all over Canada here today. I love that. Buying your first property. That's great to hear. And Brandon is also a first-time investor. That's great to hear, Brandon. Chantel has got 4. Same with Kelly. Kelly, how's it going, dude? Good to see you on the webinar, bro. We've got Kajana recently bought first. Oh, congratulations on your first rental property. That's awesome, dude. Tessa, we're trying to get our first investment property in 2022. So you got some saving going on here. That is very smart planning. And we've got Jack, a mortgage broker, first time investor. Love it. And we've got Ricardo from Windsor looking to purchase his first property. That is exciting. We've got Mansoor, who's also a new investor in the BRRRR space, who's done a few flips already. Chris, also first time, just about to refi from Reno. Eyes on the next one. Love it. Ahmed, also first time. Brandon, looks like we've got a bunch of first timers here. This is awesome. Justin Sleep also has his first and is looking for the next. Brett, we've got an aspiring first time investment property and homeowner. Santhia, we've got 3 units, and we've got a few first-time investors here. Also in the Edmonton area and lives in Ottawa. We've got people from all over. I love that. And we've also got another first-time investor, sunk everything into crypto last year. Wow, I'm sure there's a story there. That sounds like we'll have to talk later. I am definitely a crypto newbie, but I'm surrounded by people who are in that space. So that is awesome, man. We've got 4 properties and working on the 5th. 2 units and 5 pre-construction. Wow, that is awesome, dude. Brendan M, we've got property managing a cottage property and seen the money going into other people's pockets and wants to own his own. Well, Brendan, I own a cottage investing company and wholesaling company, so we're gonna have to talk after this as well. So make sure you reach out to me on the gram. And we've got Craig as well, who has 6 in Hamilton, 2 in the Dominican. Ooh, oof. That sounds great, dude. Adam also looking for his first in Montreal, and we've got someone from the Cottage group here. Awesome. I'm based in Vancouver, though. Not sure if you are aware of any groups that does something similar in the BC area. Right now, I'm not, but maybe we'll have to connect and expand out that way as we build out Ontario. So definitely appreciate all of your comments, guys. And it looks like we've got a good spread. Some people who have multiple units at this point, and we've definitely got a lot of first-time investors. So yeah, I appreciate you all commenting here. Now, Josh and Aaron, from your perspective, you mentioned a few things about the paperwork that you need to actually have to get into your first property. So I like to call this the impress the bank folder. This also applies to your mortgage agents. You want to have everything nicely labeled and ready to go so that they can actually sort through it with you. So you mentioned a few documents that you definitely need to have. So let's just run through that real quick again. So what are all of the things that if I am coming to you as a first-time investor, I need to have? So you mentioned taxes from the previous years, and what else?
Yes, we're going to say income verification documents. So if you're a salary employee, letter of employment,
Yep.
pay stubs. If you're an hourly
Okay.
employee, I need 2 years T1 generals, notice of assessments, and possibly your T4s.
Yep.
If you pay yourself in a corporation, I need your T5s.
Okay.
You are business for self, your T1s, T4s, or T5s. If you pay yourself, possibly your corporate taxes. For your verification documents for the properties that you own, so your non-subject properties if you're purchasing another property. Property taxes, we need your current mortgage statements. If you have a lease, your leases.
On the mortgage statement too, the big 5 banks, like we know they only put out an annual statement, so we get that. The best thing, like that won't work unless you're literally buying a property right when that mortgage statement comes out. So if you're halfway through a year, logging into your bank account, taking a screen grab or a print screen of that bank account information, making sure your name's on it. We do have to verify that account. If the address is on there, perfect. If it isn't on there, make sure the mortgage number is on there, and we can refer back to your original mortgage statement and connect those two together. But the banks are, and the monoline lenders are all very much about connecting the dots. So if it doesn't have all the information, make sure it does. Like the worst way to grab information is off of your cell phone. So like cell phone screenshots and using the cell phone apps, they don't provide enough detail. So making sure everything's done off of the web browser and on your desktop is the best way to grab all your documents.
Paperwork for crypto investments. That is a great question, Justin. Okay, so we've been seeing a ton of people putting crypto on their personal net worth statement, which is great. Aaron and I in crypto, we've been in it for a while. We love it. It is definitely a new asset class that is appearing more and more on people's net worth. In regards to showing it as an asset, just list it the same way you would any other asset. There's no need for proof of an asset in a mortgage application unless a bank requires it, which they usually don't for residential real estate. If you're using the funds as a down payment source, they are going to require it be in your bank account for 3 months. So you're going to have to cash out, transfer the funds from the exchange to your bank account and have it sit there for 3 months. That's specifically because anti-money laundering laws. 3 months is enough time for the bank to go through their FinCEN or FinTrack to ensure that there isn't any dirty money being laundered. And at that point, we can use the funds as a down payment source. In regards to other documentation, if you are buying a property and it's not insured, we need an appraisal. We order the appraisal. You guys can't order the appraisal, so don't go ahead and order the appraisal. You're going to burn $600 really quick. You're going to have to pay for it again. And that's essentially it. Like, it's not overly complicated and cumbersome in regards to what you need to give us. It's just having it all ready in PDF format, possibly labeled. If you have an accountant, just ask them to send you the last 3 years of all of your tax documents in a file. Keep it in a secure file on your desktop. Take a scan of your ID, and it'll be very painless. It'll be very painless for you to be able just to drop it into our online secure portal, and it's super quick. And it allows us to be able to do our job extremely effectively if everything is just there in front of us.
Yeah, and we actually use an application system where you can fill it out from the comfort of your home, and it will scan all the details that you submit into the application and actually automatically request all the needed documents based off of your details. So if you say you're a self-employed employee, they're going to ask for business bank statements. They're going to ask for your business license, corporate articles. So all that stuff will be put in there. So just make sure if we send you an application, fill it out as full as possible, because all the documents will be automatically requested based off the details you fill out. So no need to really remember all of this, but just like we said, it is a good idea to kind of get it started, because you will need to submit them in at some point.
Now, for anybody who's looking to purchase commercial real estate, so we can go down the deep rabbit hole of commercial real estate, and if you want to watch one of our videos, go ahead and watch it. We just launched it. It's great. It's called Small Commercial. It allows you to buy multifamily property with commercial financing, so you don't have to be using your personal qualification to actually buy a duplex or a triplex. It's a game changer. So if you do want to check it out, go check it out. I'm not going to explain it here today, but there are some additional documents that we would need from you to be able to underwrite these deals. So if you're going to be buying a multifamily property, we need a rent roll. So, we need either tenant acknowledgements or the leases that are given to you by the seller. We need property taxes. We estimate, if you don't have the numbers from the seller, we estimate the insurance costs, utility costs. So if the tenants pay utilities and it's all pushed to the tenants, it's zero. But if it's not, usually the seller will have some sort of utility bill, or if they own commercial real estate, they'll have their notice to read your financial statements. You're going to require at least 2 years from a commercial lender to be able to verify the expenses. Once we can verify the income and expenses, essentially we can go underwriting our job. We need your articles of incorporation if you're purchasing it through a corp. So your shareholder registries and your bylaws. Borrowing bylaws are important for a lot of lenders. It allows them to understand who can actually sign or has signing authority to borrow money through the corporation. ID, T1 generals, NOAs. If you do have bare trust agreements, make sure you have them written and maybe have like an attestation from your lawyer verifying the bare trust that goes into that corporation. And a DSCR sheet. So Aaron was talking about portfolios. So a lot of these lenders, when they're lending you commercial money on your property, they're going to want to see an entire picture. So we want a good understanding of your entire portfolio as a whole. So if you're a professional real estate investor, have some sort of spreadsheet that outlines your debt, your income, what kind of loan is on it, and that allows us to be able to go to a lender and say, look, Mr. Lender, this person has $1 million net worth. They have phenomenal properties. They're all cash flowing. It's a great, he maybe doesn't make $600,000 in income and can't afford this $3 million property with his own income, but look at the income that's being generated on the property. It's self-sustaining. It's meeting the minimum requirements. He has great credit, and the pieces all eventually fit. And the lender's like, okay, this makes sense. And that's how people end up scaling their rental portfolio. You can only show so much income on paper. You can't, keep claiming, well, some people can, but it doesn't make sense to keep claiming, $50,000 more every single year in your T1 general. You're going to pay it all to the tax man. So most investors, they hit a wall with a bank. They start to look into these products and how they can help them not use their qualification to grow.
Yeah, and on the small commercial side, I know we talked about it, but even though you aren't having to personally debt service everything, they still do want to get a whole picture of the entire scenario. Just because you're purchasing a multi-million-dollar building that debt services doesn't mean they don't want to see how leveraged you are, what your credit score is, and if you have a portfolio of properties, are they a liability to you or are they an income producing asset? So that's kind of where we get into that. I know Stefan had said there about not requiring personal income tax. They still are going to ask for your last 2 years of T1s and NOAs. So have them together. Again, they just want to see how strong you are. Are you relying on the cash flow from this property to have any sort of income, or do you have income coming in from your holding company, from your real estate portfolio, or from a job? How are you going to maintain the property in terms of any property management, repairs and maintenance? If a boiler goes or an air conditioning unit goes, how are you going to be able to pay for it? Do you have income coming in? So that's really what they're looking for when they ask for these additional docs. No, they're not personal debt servicing it, but they do want to get the sense for how strong the deal is in its entirety.
Absolutely, yeah. Definitely appreciate that, guys. Now, one thing that you actually said there that I really want to highlight, and going back to one of your previous points too, is you want to be running this like a business. So actually breaking down and putting into a spreadsheet all of your different properties that you own. So we had someone who commented at the beginning here, and they said that they had 22 units already. So that was Mandu who mentioned that he has 22 units. So for Mandu going in to get financing on his next deal, if he were to break down all of these units, what their income potential was or what they're currently getting, that really helps actually speak to the character as well of these investors that we're talking about. And even if you're a first time investor, like breaking all of that down, it really stands to the fact that you just thought this through, and that you're like going through and analyzing the deal, and you've analyzed your income, you've analyzed what your affordability is already, and now you can just further have a better conversation with you guys ultimately when you're looking at a property. And I really do appreciate the point about running this like a business. It really is, at the end of the day, guys, like people do this full time. They can live off of these funds. A lot of people are able to be financially independent and actually retire from their day job because of their investments. And this needs to be run like a business. So I definitely appreciate that you've highlighted that. And I really do want to emphasize that here on this webinar is just keeping track of the documents and managing it like a business. Now, I did have a direct message here of a question that I just wanted to read aloud so you guys can answer it here. So when acquiring your first investment property, can you get financing under a corp, or does it have to be financed under your personal name first? So great question. Thanks for asking. And Josh and Aaron, feel free to jump in here.
Yeah, the holding corporation question is an interesting one. Most of the A lenders, well, pretty much all the A lenders that we were working with have no longer decided to continue to put up mortgages in the holding company names. So for us, that is a no-go at this point with conventional A lenders. Now there are Schedule B lenders that do work with holding companies, so we can get things done on the B side. Small commercial and commercial, of course, they absolutely love the holding companies. Now on the commercial side, if you're purchasing in a holding company, if it's a brand new holding company, that's fine. There usually isn't any issue with that. If you've had your company for a few years, any corporate financials, notice to readers, make sure those are prepared. HST statements, make sure those are all good and up to date. They will just want to understand, get an understanding of how that holding company is functioning.
Yeah, so I mean,
Awesome.
I think a lot of banks, what happened was about a year ago. So it was available about 12 months ago. It's no longer available now. I think it has a lot to do with risk and has a lot to do with once something goes power of sale, it's very difficult to be able to take back or power of sale a property from their perspective. So it's much easier just to have people purchase rental properties in a corporation. As Aaron said, because that's very personal, right? Like if someone personally buying the rental property, it's good. But once you move to the commercial side, they allow you to do it because you're running it as a business, so you can have it as a business. Right. There are a ton of advantages to owning rental properties and corporations. Highly recommend speaking to an accountant who understands how to do this properly. Don't just open a corporation because everybody says you should. Do it because you're tax advantaged and understand the ramifications, the advantages and disadvantages of owning them in corporation and how they might affect you moving forward.
Right, absolutely. I think that answer really comes down to your why is what we circle back to. Like, don't just do it because, like, actually understand why you're doing it. And then that really leads into the next question really well. Is it true that it's more difficult to refinance a property held within a corporation versus if I held it personally? So I'm sure that circles back to the why as well. But if you guys want to kind of touch on the difference really between refinancing from a corp versus a personal name.
So yeah, the corporation really just determines what type of lender you're going to be able to go to. If it's in a holding company versus your personal name, if it's in your personal name, you're going to have a much larger selection of lenders to be able to work with, and some more options. If it's in a holding company, you do limit yourself to the lenders that are only going to be looking at the holding company. So you're going to be looking at a Schedule II B bank or some sort of small commercial or commercial lender. In terms of comparison of products, the small commercial definitely has some better rate and terms compared to the B side. B rates on the rental properties, they're not terrible rates. You're looking at from 3 to say like 3.24% on the lower end. There are some higher end rates when you get into like the equitables and the home trust. You're up here 2.75%, maybe up to 4%, depending on what type of property it is, where it is. Where the small commercial lenders, they have longer terms, so you can get up to that 5. They do a 7, they do a 10 year if you really wanted to go that long. But they have variable rates, which is a big plus for a lot of investors. It opens up the flexibility of the term of the mortgage, allows you to exit out, refinance, sell your property with minimal cost to break. Whereas on the B side, they are for the most part fixed rates. There are some lenders that have variable rates, but the rates are a little bit higher. You're looking at 3.5%, whereas on the small commercial side, we have rates as low as 2.7, 2.8, maybe even 2.6, depending on the situation. So there's a lot more flexibility on the small commercial side. So in terms of just whether you're purchasing or whether you're refinancing, the holding company really just either, it does limit who you can go to. Now, one of the things to keep in mind too is that like on that small commercial side, being able to refinance out like in a BRRRR strategy. If you're looking to purchase in a holding company, the B lender can be a good option to be able to just get into the property, purchase it, in a holding company. When you're purchasing, and one thing to note, when you're purchasing properties in a holding company on the residential side, you're still using all of your personal debt and income to qualify. So if you have 4 properties in a holding company and 4 properties in your personal name, you have to debt service all 8 properties just off of your income. Now we can still use the leases and stuff on the non-subjects, but it is still also based off your personal debt servicing on the residential side. That's on the A side and on the B side. So keep that in mind. The B lenders, like I said, you can use the market rent report to help get that property purchased, get in, do your renovations. And then, once we've been able to take a look at the rental income, and one of the cool things about the small commercial is that right at the initial purchase, when you give us your estimated ARV, we can already tell you for takeout financing on the small commercial side exactly how much rental income you're going to need to, to meet that mortgage amount. So if you're buying it at 250 and you think it's going to be worth 450 afterwards, we can tell you, hey, this is how much rental income you're going to need to be able to qualify on this takeout. That's going to allow you to be able to do your renovations a little more strategically. Do you need higher end leases and rent amounts to be able to qualify? Well, then maybe you're going to have a little more, higher end finishes, or maybe you're going to spend an extra $10,000-$15,000 to make sure it appeals to that higher end, that higher end tenant. If it's a 4-unit and maybe you don't need as strong as rental income per unit, maybe you don't have to spend that additional 10 to 15,000. You can put it into something else. So we can tell you right away how much rental income you're going to need to be able to get that BRRRR done. So small commercial is a great tool. The B lenders are a great tool as well too.
Absolutely, that's awesome.
And one thing I want to add in there too, Rebecca, before, because this was important, and I'm dealing with this right now, and it's very frustrating for both sides. But on the BRRRRs, when you guys are completing your BRRRRs, make sure you keep very detailed records. Take before and after pictures. Keep all of your receipts, and keep an Excel spreadsheet. So one of the files I'm working on right now, the clients bought the property, put in $185,000 in renovations, and now we're trying to refinance it out in 5 months, which is 6 months is really the ideal timeline to get a refinance done. Well, they wanted to see $189,000 in receipts and invoices. So, it took a while to come up with. They hadn't, followed up with all the contractors while they're doing the work. All that stuff was paid cash. So they didn't have any record of it at the time. They had to go back, get invoices and stuff like that. So, make sure it's detailed, make sure it's all organized, and make sure it all adds up. If you're looking to do a refinance within 6 months, it's very difficult. There's a very select handful of conventional lenders who will do it. Small commercial is a little bit easier, but they're still going to want to have a good understanding of why your property's now all of a sudden worth this when you bought it 2, 3, 4 months ago. So the more detailed records you can keep and the more proof you have, the easier it's going to be.
Definitely appreciate that. Yeah, it is so important that you track down these receipts and keep record of them. And before and after photos are huge, especially if that appraiser is going in afterwards and you can actually show them like, hey, this is what I did to this property. Like, this is what it looked like before. And they're able to actually see the increased valuation here, not only from the comparable sales, but also just in what you've done to that property. So yeah, definitely could appreciate that. Next question here is, what if you're taking out a HELOC to pay for the down payment? Do you also need those funds in your account for 90 days?
No, that's not how a HELOC works. So HELOC is built-in equity in a property. So you can't necessarily, so I think what you're asking is, do I have to draw it out and hold it for 90 days? No. So the 90-day thing, 90-day rule isn't necessarily a duration period of capital having to be held in a bank account. It is specifically, you need to show where the funds have come from over the last 90 days. So for example, if you're saving up money and you're getting paid every single month from your job and that money goes in your bank account, you can use that money for a down payment. That's not a problem. You just need to be able to show me where the money's coming from. So a large amount of money comes into your bank account from a crypto exchange. That doesn't fly, because that's unregulated. Nobody knows where that came from. That's got to stay in your account for 90 days. But if you have money in a home equity line of credit or just regular unsecured line of credit, we can source where that came from. So there is no duration to actually hold the funds in your account.
Yeah, and you don't need to pull that out ahead of time and put it in there. So there's no need to pay 90 days of interest on that. As long as we let the lender know where the funds are coming from, we're going to have to take that into consideration when we're doing our debt servicing. So it's important to let us know. Definitely don't surprise us ahead of time, like it's a week out from closing, and say, well, I'm actually going to pull from my line of credit, because anytime you borrow that down payment, we do have to factor in a debt servicing. So that could be the difference between you getting your mortgage and you have been qualifying for maybe a private or a B side if you're trying to get it done A. So just let us know ahead of time. But
absolutely love that. Now, here's something that hasn't actually come up on this call yet, is changing things unexpectedly before closing dates of properties. So, you meet with your mortgage agent and you're qualified for the lending, you're good to go. You have everything lined up for closing, and then, ooh, fancy car comes along, or ooh, that boat looks nice. Let's go splurge. What can happen, or what have you seen happen with investors or otherwise before closing? What are some of the horror stories?
That is a very expensive mistake, people. I highly recommend not doing it. I had a client who went out and bought a brand new car on a home equity line of credit right before closing. We ended up making it work, because she ended up getting a 12-month. She ended up literally getting a 12-month term on the car. They ended up being like, okay, well, the term is longer than the car payment, so we ended up factoring it. It worked out. But there's so many instances of people going and putting things on credit, or buying expensive items, or even just like shuffling money around in your accounts. It causes so many issues. If your ratios are out of line, so put it this way, like there are very strict parameters for an insured mortgage. Insured mortgage is federally mandated. Like they have 39, 44 GDS, TDS. If you don't fit within those ratios, you do not qualify for the mortgage. And if you say, for example, you go firm on a deal and you only have enough money for 5% down, and your ratios are out of line, you no longer qualify for an insured mortgage. You either need to come up with more down payment to get the ratios in line, or you're going to have to put 20% down. If you put 20%, you're going to have to find that money somewhere. I highly recommend, from the time you go firm on a deal, or the time you get your approval, until the time you close on the deal, the day after, go buy the furniture. The day after, go decorate the house. But don't take any credit. Don't buy anything that's super expensive or has a monthly debt obligation to it, because it will affect your ability to be able to qualify for a loan. All mortgages are based off of two ratios: a gross debt service and a total debt service, which is essentially the total gross annual household income, and a percentage of that is for 39% of that total gross annual household income is for all the expenses to own a home. And your total debt service is all those expenses plus any outside expenses: cars, student loans, lines of credit, home equity lines of credit, all those expenses. So 44% of all the money you make at home can go towards all your expenses. And if you don't fit within that box, you don't qualify for an A mortgage, which is why you usually hear people, why can't I qualify for a mortgage? Why is my mortgage qualification so low? And that's why. It's because the amount of the ratios that the government allows you to use is extremely difficult to be able to fall within. And we're qualifying at 5.25%. That's something called a stress test. So the government put this into effect to ensure that people can actually afford the loans that they're in if rates do go up. So currently right now, if you came to me and said, Josh, I want a variable rate, I can get you 1.35% or whatever it is, but you're actually qualifying at 5.25%. So that gap there ensures that if rates go up, or when they go up, you're going to be able to actually afford the home you're in. It might seem challenging at first to be able to get into a property, or might seem like a deterrent, but it is also a safeguard for the economy. It ensures that people can truly afford the homes they're buying.
And it's interesting, like one of the other silly mistakes that people do is either quit their job or change jobs up into the closing day too. There's something that the lenders will do as like an employment verification. They will call your employer to make sure you do work there and you still work there, and they will wait literally until 2 days before your mortgage is closed to call that lender to make sure nothing happens. And there have been cases in the past where, a day out from the mortgage, the lender calls, and all of a sudden we get a call from the underwriter who's like, hey, like, I just called this person's employer, and they don't work there anymore, and they quit, and now they're at this job, and or maybe now they're self-employed, or they took a job that was making $20,000 less, and the mortgage is now it's canceled the day before closing. So now we got to rush to put together a private. So don't change jobs or quit your job beforehand. If you're thinking of changing jobs or changing industries or whatever it is, divulge that to us. Let us know. Let us have that conversation. Let's make sure everything's done properly and appropriately, and there aren't any surprises, like the day of or the day before closing.
Yeah, really good question here. Is it true that credit unions don't have to use a stress test? So for uninsured mortgages, that is correct. Credit unions are private banks. They can essentially lend their money however they would like, as long as it's an uninsured mortgage product. So as long as you're putting at least 20% down, they don't have to stress test it. If you're putting less than 20% down, you still have to follow the insurer guidelines, which requires you to stress test the loan. That's why Meridian, for example, can qualify a contract rate. So, if you needed to squeeze in ratios, they have a little bit of a higher contract rate than most conventional lenders, but they allow you to be able to qualify at that rate set of the stress test.
Awesome, guys. Well, we've got a lot of questions here, so I'm just going to go rapid fire with it. So we've got a question here. Does money from a trading brokerage need to be seasoned for down payments?
No, as long as you can show the history of the money.
Awesome. Next question here is, possible to get a mortgage on which down payment 20% is financed by the seller?
VTBs. Conventionally, no.
Yeah. Even a private mortgage, like unless the property is, severely undervalued on purchase, and there's quite any lender's probably going to want you to have at least some sort of skin in the game. Like even credit unions on the small commercial side, 10 to 15%, like they're still going to want you to come up with a little bit of cash. Private lenders, depending on the deal, still may want you to have a little bit of skin in the game. It really depends. It is situational, but traditional type mortgages, like Josh said, no. Conventional mortgages and BTBs do not mix.
Got it. Okay. Next question is, me and my wife are in work permit, and we came to Canada 3 months before. And number one is, do we get a mortgage with a work permit? Number two is, which mortgage option can best fit an A, B, or private lender? And three is, how to avoid foreign investor tax of an additional 15%.
Sure. So a few things. I would recommend, so there's a new to Canada program that specifically helps people who are new to Canada get mortgages. It is a insured mortgage program, so you can go and take a look at that. There are A options. The A, B, and private options are all going to depend on how much income you actually claim and in Canada and your employment history. We do require some sort of credit history. There are a handful of ways for us to verify your credit if you are new to the country. If you have a trade line, that's good. Or if you can prove that you had trade lines in your other country back home or wherever you came from, that will also work. And in regards to foreign home buyer tax, that's only for the Golden Horseshoe area. So depending on where you live, that might not affect you. But if you are, it is something to definitely be aware of, because that's quite a bit of cash to put down, especially if you're not expecting to put an extra 15% down and not get it back.
Absolutely. Okay, next question here is there a way to get fixed interest rate until the entire loan is paid off, like a 25-year mortgage?
I don't think you can do it 25, but I know there are some lenders will do like a 7 or a 10 year. The chances are you're probably going to want to break that mortgage at some point throughout the life of that 25 years. Like you're going to build up a significant amount of equity. To lock that in for 25 years just doesn't make sense. But you could get a 10-year mortgage on a small commercial if you really wanted to.
We've done hundreds and hundreds of mortgages. Never have I seen anybody take a 10-year mortgage.
Awesome. Definitely appreciate that context there, guys. Yeah, fair enough. Okay, we have a comment here from Tessa saying, I just watched a great video from Matt McKeever that explains this very well regarding being incorporated right away or personally. Absolutely, Tessa, thank you so much for that comment. And make sure you guys all go over and subscribe to the Canadian Real Estate channel. We are definitely I think we are already the content kings and queens of Canadian real estate, but we're certainly expanding that even more through this year. So Tessa, thank you so much for that comment. Make sure you go over and subscribe, and make sure you watch Matt's video as well about canceling his channel. Okay, next one is from Chantel. She says, I understand lenders don't like short-term rentals. Are there lenders out there who will approve the purchase of a cottage with the proposal of a short-term rental? Fantastic question, Chantel. I love cottage questions. So let's hop on over to Aaron and Josh for this awesome short-term rental question.
No.
Yeah.
The Airbnb history has lenders will not lend on Airbnb properties. So if you are purchasing a cottage, you can buy a cottage as a vacation home or a second home. You cannot purchase a cottage as a vacation rental. Even buying a cottage, like there are properties in cottage areas that are houses. Then there are properties that are like on the water and like, yes, this is a cottage. If you're trying to get a fair market rent, on a Kawartha Lake cottage, the lender's probably going to see through this or want a very good explanation of why you think you're going to be able to turn this cottage into a long-term rental. We cannot use short-term leases. Now, if you are an Airbnb investor, I can use Airbnb income as a secondary source of employment. So if you're running your Airbnb in through a holding company, I can use a bank stated type income to use that income to help qualify out there and use that as employment income. There are some lenders who will use non-subject rental property income. So if you're buying, let's say, a primary residence and you own an Airbnb, if you've claimed that Airbnb income for the last 2 years on your taxes, then you can show it. There are some lenders who might allow you to use a 2-year average of that to help qualify. But even still, like, that is hit and miss. Really, the best use of Airbnb is claiming it or running it through a company and then using that as a secondary source or another source of employment income. And we do have some success with that. But lenders don't want to actually lend on the subject property as an Airbnb.
Yeah, if you guys tell a bank or tell anyone or tell your broker that you are using it for Airbnb, it will kill your deal. Do not. The banks won't play ball. Not yet, at least. I think there might be obviously some talks down the road, maybe one day. So to kind of peel back the onion here and for everybody to realize why there's no guarantee income for that specific property. Like, when you have a lease, it's a contract between one person and an owner of a property that guarantees a certain level of revenue on an asset. And that, to a bank, is like gold because it's a contract. It's legally binding. So they can guarantee the revenue on that asset. Whereas everybody knows you can make a ton of money on Airbnb. It's great, right? But there's no guaranteedness to that. It's a lot like if you're an hourly employee versus a salary employee. A salary employee is you signing the contract. It's guaranteed. I can guarantee you're going to make that amount of money. Good, you can get a loan. Whereas hourly, I can't guarantee anything. So you need 2 years history. The same thing with Airbnb. Like, if you're going to have Airbnb in your portfolio, claim it on your taxes the same way you would with the statement of real estate rentals for a long-term rental. Eventually, you'll be able to use the income to help qualify for non-subject properties.
Got it. So let's say somebody is buying their first short-term rental property. How should they approach that? Is this something that they're going to be just buying a cottage property as a personal investment and then renting it out as Airbnb later on? Is that a good strategy, or how do they even broach that with lenders? Like, what type of lender would they even be able to get?
Yeah, I mean, like, what you do with your cottage after you buy it is up to you. Like, we can't submit an application with the purpose of it being an Airbnb. And I know Brendan's watching because we were having this conversation the other day, but it's something that we're trying to figure out. Like, eventually there has to be one lender who's going to break into the Airbnb space. Now, like, something else to consider too, like, if you start submitting in cottage after cottage after cottage, like, it is up to the lender's discretion if they want to lend. You could qualify, you could have, $1 million of tax proven income and no debt and qualification. The lender doesn't have to give you a mortgage. They can say no for whatever reason they want to. Just because you qualify doesn't mean they have to give you a mortgage. So if it doesn't fit their policies or they don't feel easy lending on it, they don't have to lend on it. So we're trying to find a lender who's willing to work, and it's, we're always trying to push the industry forward and find new products. So it's something that we're looking for, and, trying to find a legal way to be able to purchase Airbnbs. And it is something that we're on the hunt for. And believe me, as soon as we have a product that allows you to come out there and buy Airbnbs, we will let everybody know. So,
but
challenge accepted.
You cannot buy a rental property that is a short-term rental. So you're either purchasing it as an owner-occupied rental, an owner-occupied cottage, or a long-term rental.
Yeah.
Got it. Okay, awesome, guys. Well, I definitely appreciate the context there. Challenge accepted. We'll keep working on that. And on to the next. Keep hammering away. On to the next question here. We have a question that is: if you're building, or if you're buying rather, a new building, quadruplex for rental purposes, and have to pay taxes, any way that you can add the mortgage in a commercial loan, do you use it as an advantage to get tax rebates in cash?
My HST. I'm kind of confused with the question. Are you talking about like tax on the new builds? There's no way
Yeah,
to build the tax into the loan amount. So what happens is when you're buying a new build property, the lender's only going to give you a loan based off of the contract that you signed when you first put the deposit down on the property. And then you close in the contract. You obviously have a large equity position because if you bought it pre-built, it was 3 or 4 years ago, and the equity in the properties increased based off of the appreciation year over year. But you can't access it until you refinance it. So there is no way to build your tax, your HST or whatever you have to pay from the builder into that loan amount, unless obviously you close privately. There are always ways to be able to do it. Like there are true equity lenders out there who will value the property of the as is date right now, and they'll give you a loan based off that value. But how badly do you need the capital? Is it worth the private rate and the fees that you're paying to access that capital?
got it. So Yannick, if you want to hop on here and just clarify if that answers your question, or if you had another question that you had in mind, feel free to unmute yourself.
Can you hear me?
Yes.
Yeah. Okay. So yeah, so basically it's because my plan is I have a new build under contract that I'm gonna have in like 5 months. And so yeah, because it's a new build, it's rental purposes, I obviously have to pay taxes. But I went to the Cottage de Jardin. They're giving me a mortgage, like a residential mortgage, and they're adding the tax on it. And I have the equity to pay the taxes, but just for a 25-year or 30-year mortgage, they're adding the tax on the equity. And so yeah, so that was my question.
They are adding the tax on.
Yeah, they are. Like, and I went to a mortgage broker, and he said no, they don't do that. And then I went to the Kaiser, and I've had 2 properties before with them, and they told they're basically I signed the mortgage with the tax in it.
That's unreal. Yeah. So every on the books, like the rule is they don't do that. So the fact that you walked into the bank and they could do that for you, obviously it's an exception that they made to be able to allow you to do that. But
what I'm trying to find out, what I'm trying to find out is, do you think I can have 4 rebates? You know, it's $24,000 approximately the max for 1 rebate, but I have 4 separate units. So do you think I'm gonna be able to get 4 rebates for each unit, which would probably be less than $24,000, but you know.
I would say it's based off the building itself, not how many units are in the building.
Yeah. If you closed on 4 individual properties with 4 titles and 4 mortgages, that'd be different. But if it's one single mortgage over 4 units, then you probably just get 1 rebate.
Okay, that's what I was wondering. Okay, that was my question.
Awesome.
Thanks, guys.
Thanks for hopping on. Awesome, guys. Next question here is actually coming in. Oh, we still got some feedback coming in here. There we go. So Jawad is asking if we can provide the list of B lenders and small lenders. You know, we can't give away all of our secrets. Come on, man. Come on.
And just for the record, B lenders are like broker lenders. So there isn't really, like, you can't just walk into a B lender and apply. So even if we wanted to, it wouldn't really be a whole lot of use.
There are a ton of Schedule II B lenders in the space. They all have their own individual niches that they excel in. So if you do want to have a conversation about your specific situation, we're always happy to talk about what the advantages and disadvantages of them would be.
Awesome. Yeah. And another way to get lists of lenders would be to become a mortgage agent and build a mortgage company. Then you will have the list. Okay. Next question here is coming in from Sheena. And this question is, are there any restrictions on getting a single family home mortgage when the seller is willing to structure a VTB to finance their full down payment plus improvements? If so, are there any ways to work around that? For example, a promissory note to get a loan from the seller after qualifying for the mortgage.
I mean, if after qualifying for the mortgage and after closing on it with, like, you know, if it's a conventional mortgage, again, like going back to that question we had earlier, conventional mortgages on the A side and the B side are not going to allow you to use a vendor take back because you federally cannot have secondary financing to cover your down payment. On the small commercial side, they do allow you to have a small portion as long as you can debt service it. So the rental income on the property, if you were purchasing a property that had leases in place, would have to be able to cover your first position and the vendor take back. They're not going to give you a full 20-25% vendor take back. They do want you to have some sort of skin in the game. So whether it's a 10% down payment if you're a really strong borrower, or 15% down payment, that is an option. Now, if you had a fantastic rate, like let's say they were doing a 0% interest and it was going to give you 25% or 20%, you could structure a smaller first position mortgage if the rate on the vendor take back was better. So you could take maybe a 50% vendor take back, take a 25% VTB and come up with 25% or 10% of your own funds to help do that. But they're not going to give you the full down payment from that vendor take back. So that's well, even on this one.
Well, I mean, you can go private. So if you went private and you had a VTB, I mean, you could be as flexible as you'd like in regards to not putting any capital in the deal. It really just depends on, again, what are your goals? How do you get out of it? What is your propensity to cost? And does it make sense? If we can, if it makes sense for you to take that private loan for maybe 6 months, do what you got to do. Keep all your capital as active capital to be able to reposition the property, do the renos, increase the value, and then refinance. It sometimes makes sense to do that. So VTBs are great. They do not work with A financing.
Sometimes too, you can include like seller credits in the conditions as well too, which might be something. But in terms of like a promissory note given from the seller afterwards, whatever happens after you close, and if you closed everything with your own sources and AML property, they want to give you a promissory note, and that's something that you've worked out with them. That's up to you and the seller, but in terms of using that for the down payment, isn't going to fly conventionally for the most part.
Awesome. Now, next question is from Justin Sleep. He's asking, if you are the person doing the renos and you have your own reno company, can you submit your own bill for the records?
I'm not answer that question.
I would just say track everything as much as you can. Like if you're doing the own rent, like if you're doing your own renovations, you're still going to have bills and receipts for the materials paid. Just keep track of all your receipts.
If you opened up your reno company like the week before you did your flip, probably not flying. But like if you actually own a construction company and you do this for a living, and you can prove that on your T1 generals that you have consistent income from that source and you're a professional at what you do, we can make a case for that.
I would just keep track of everything as possible. As much as possible.
How successful or useful is this?
Definitely appreciate that. Okay, I have an answer for this. Just wait, guys. The Smith maneuver, let me tell you, as long as it's the Will Smith maneuver, it is very successful. But you guys can talk about the real estate Smith maneuver. I just had to play this because I saw that. And shout out to Hitch. Hello, the Smith maneuver is the best maneuver ever. Okay, I'm done. You guys can answer the question.
The Smith maneuver is a great strategy. Essentially, if anybody doesn't know what it is, it's taking all your amortized debt, paying it off, and just taking a line of credit, because you can pay off you can write off the interest on your line of credit. So does it work? It does work. Is it difficult to do? Like, it's not necessarily the easiest thing to structure. So home equity lines of credit are a little bit more difficult to be able to qualify for than traditional amortized loans, just because the qualification rate is usually higher. Now we're in a low interest rate environment, so it doesn't necessarily mean that that's the case right now, but usually it is more difficult. One of the challenges that we find with investors who have multiple properties is that if you haven't structured it properly, and say you bought like 4 properties in your name and you have your personal residence and it has a HELOC on it, restructuring that debt is going to be difficult with the conventional lender who offers that product, because you already have other properties and mortgages in your name. So working with a broker is going to allow you to structure your deals maybe in a corporation to allow you to be able to scale without affecting your personal income or your personal debt servicing might be really important if you're looking to take advantage of the Smith maneuver.
Love it. And, maybe work on some dance moves too. Okay, so next question here. Now we're getting pretty close to the end of this webinar. So guys, if you do have questions that were missed, make sure you just follow up with them. I'm going to be sending out a follow-up email that's going to ask for some feedback on the webinar. So if your feedback is make sure you answer my question next time, I'm just going to forewarn you that we will try. But please do send your questions through. We had a lot of fantastic participation in today's webinar. So if we didn't get to your question, just make sure you respond to that email that I sent out, and then I will actually follow up with the Findlay guys and make sure that we do get an answer to you, because we always do appreciate your questions and participation on these webinars. So I will read one final question here before we get into our flippin-tastic off-market deals. So this is the last one here from Dana is, can you please speak to financing options for properties bought by a person, but the beneficial owner is a corporation? What type of lender would finance it, and would this count against my income, assuming it's not a commercial property mortgage?
That's a great question. So that's called a bare trust agreement. So somebody who purchases a property in their personal name can use a bare trust agreement to move the tax liability of that property into a corporation. It's great for estate planning. If you already own assets, go talk to your accountant and they'll be able to help you out with structuring how that works. Now, when it comes to qualification, you still qualify for the mortgage personally. So the advantage if somebody would like to is they qualify for the mortgage based off their personal income, but they don't take any of the tax liability because it moves into the corporation. We see it used quite a bit when people are maybe moving a little faster than what they should have. So when people scale very fast in their first year of business, for example, I have a client who bought, say, 6 properties in the first year, and he didn't go talk to the accountant until the end of the year when, he had to get his taxes done. And the accountant's like, you should really have set up a corporation. So, unfortunately, it's going to affect his personal debt servicing forever unless he pays land transfer tax and moves them into a corporation. But the actual tax implications and how he goes about claiming the income from those properties moves into a corporate structure and allows him to be able to take advantage of running it as a corporation. So he does his notice to read your financial statements. He can run all his income through his corporation. He has his expenses. He can write things off. He can also T5 or T4 himself, which is going to allow him to take advantage of personal tax implications as well. This is a great tool to have as an investor. If you do own properties that are currently in your personal name, highly recommend, again, speaking to an accountant who truly understands how this works to give you some sound advice if this is going to work for you.
Yeah, and it can help you shift that property. If you start to max out on your personal side and you want to swap that property out, it does set you up for a greater chance of success of transferring your company from your name into a corporation without having to pay that land transfer tax penalty, as long as the corporation is the exact same ownership as your personal name, or the personal title. So if it was just you, you would just have to be the sole owner on that corp. If it was you and your partner would have to be on that corp as well too.
Awesome. Guys, I really appreciate all of the questions, and also Josh and Aaron, I really appreciate all of the fantastic knowledge bombs that you've dropped today and answering all of the questions. So do make sure that you follow us along on Instagram at Rebecca Lynn Matheson, at Adam JD Martin, and at the Findlay team. They are absolutely regularly posting and dropping knowledge bombs on their Instagram page as well as their YouTube channel. So make sure you follow along. Now, we had some fantastic questions that we didn't get to. So it looks like we may have to run a how to get financing 101 2.0. So I will definitely connect with the Findlay team afterwards. If you guys liked this webinar, make sure you do give us some feedback. So I will have a feedback survey that I send along, and if enough people answer it, I may just have to get the Findlay team on for a 2.0 of this webinar. And also make sure you take out your smartphones, your tablets, whatever you've got close to you, take a photo of this slide and tag us on Instagram. I'm going to do that right now, and I will definitely repost the first 5 people or more that tag me on Instagram in this post. So shout out to the Findlay team for popping on today. I will give you guys a few seconds here to take a photo of this. Now, again, we do have some fantastic guests coming up over the next few Wednesdays. So make sure you do sign up for the Wednesday webinar in the coming weeks. But Josh and Aaron actually will have a podcast episode dropping very shortly on the Problems or Profits podcast. So that's co-hosted by Matt McKeever and I, and we dove really deep actually with the Findlay team, and it's a little bit different from what you guys would typically hear from our content. We actually dive deep into how they've been able to build and scale their business and how they actually got started in this space in the first place. So if you guys want to learn a little bit more about Josh and Aaron's backstory, I highly recommend that you check out that episode and follow the Problems or Profits account. We're on Instagram. We're on also with the podcast on Spotify and Apple Podcasts. And of course, we're all over YouTube. So make sure you give us all a like and subscribe. So thanks so much for coming on to this Wednesday webinar.